onto the story now. The FNB and Bureau for Economic Research Consumer Confidence Index increased to minus 16 points in the third quarter of 2023 from minus 25 points in the previous period. This is the lowest reading in over a year. The second lowest index reading on record since 1994. Consumer confidence recovered somewhat, lost ground in the third quarter, reflecting the effect of lower inflation and sustained recovery in employment had on sentiment. This current reading remains well below average, a signal that there is a low willingness to spend among consumers. I'm now joined by Mamello Matikinca-Ngwenya, the chief economist at FNB, to talk more about the latest consumer confidence print. Mamello, thank you very much for your time. We heard from another consumer index yesterday, something that was quite similar. There has been an improvement in terms of how consumers feel and their state, but this is not really showing that things are getting better, not at all. What would you say about the overall findings when it comes to how consumers feel right now?
Thanks, Golani. Good evening to you and all the viewers. So I think, the improvement firstly is quite marginal. And I think just in your intro, you highlight quite nicely that, we come from the second lowest reading of the index since 1994. So I think, it's quite important just to bear that in mind. And also, when we think about economic conditions in the second quarter versus the third quarter, there was expectation that the intensity of load shedding would probably be worse in the third quarter. The second and the third quarter because of the winter months. The intensity positively surprised. And in the time that we conducted the survey, we also saw that headline inflation was moderating with the latest print coming in below that 5%. And also the central bank in July opted to pause. They didn't hike interest rates. So there's those, I think, few elements that may have assisted the improvement in sentiment. But the point really is that economic activity remains quite weak, economic growth, barring the latest release that we've had. I think, yes, we're seeing a marginal improvement, but, the economy essentially is not where it should be for us to see confidence levels that are positive, sustainably so.
What's the reason behind high-income households, those who are earning per month 20,000 rand and above, seeing this huge rebound in confidence when there are so many concerns of load shedding, high interest rates and inflation that those affluent consumers are actually worried about?
Yeah, Golan, so the reasons that we can think about just in terms of what may have motivated that improvement. We would have seen the latest quarterly labor force survey suggest that the economy has added jobs. So that's some positive news coming from the labor side. And I think when we think about non-labor income, so this would be income that one earns from investments or interest earning investments. As we are in a very, at a very elevated interest rate. So if you are invested, that has boded quite well. And secondly, if you, participate in the stock market, some companies have performed quite well. They've paid up dividends. So non-labor income has positively surprised. So that could have also contributed to the improved sentiment in that segment of the market. And secondly, or thirdly, that segment of the market tends to be your skilled labor who tend to hang on to jobs. They're not as vulnerable as your non-skilled employees. So those factors really could have contributed to that improvement in sentiment.
Mamello, this particular index came in just after there was a dramatic change when it comes to the fuel price, that we saw the fuel price increases yesterday, and also stage 6 load shedding. Do you think those changes will drastically change how consumers feel, particularly as you look at the next survey when it comes to how consumers feel? Because 2 rand 87 cents for diesel, 1 rand 71 cents for different grades of petrol. This came in just before that, and we are seeing stage 6 load shedding as well. That would change their perceptions of how the operating environment is like right now.
Potentially. I think if we look at the survey historically, those factors have certainly weighed on sentiment as they erode your purchasing power. And, you know, you tend to see it in your middle to your lower segment of the market. So the length at which we stay at the stage 6 load shedding could potentially weigh on sentiment. If this then becomes sort of entrenched as we move through the quarter, I think it will come through strongly in the data.
What's also interesting, Mamello, is that consumers are feeling upbeat about the Reserve Bank on the 21st of September. The MPC is meeting, and the cooling of inflation from the highs of 7.1% in March to the current print of 4.7% is fueling these hopes that the Reserve Bank will actually start maybe cutting interest rates. That's not the case because what we've heard from the Reserve Bank is that we might actually see a hold of the interest rate decision by the MPC. What are your thoughts 2 weeks to go before that meeting about where the Reserve Bank might end up in terms of interest rates?
Yes, so I mean, I think if one firstly looks at the inflation profile and trajectory, it is moderating quite a bit, you know, printing below 5% in the last print. We certainly of the view that monetary policy globally, and is, you know, if I can focus on the Fed specifically, that there is potential risk that the Federal Reserve Bank also hikes interest rates. So our central bank will be looking at that. So we know that globally, this inflation story, central banks are still grappling with, and they would want to see a sustained moderation in inflation. And I think our central bank will also wait for those signs, clear indicators that headline inflation is moderating, and inflation expectations as well are moderating. So we do think that they will be data dependent. We do not anticipate them to cut interest rates this year. We think as we move through 2024, and there's better clarity around the global economy, concerns around whether the U.S. will experience a soft landing or whether they would go into a recession, concerns about what, you know, the Chinese economy potentially looks like over the next coming months. I think they will wait for those indications as they are quite important. But I think the single most important thing would be if inflation is indeed returning closer to that midpoint of the target, and if inflation expectations are also moderating and becoming anchored. So we hold the view that, you know, we're likely to see interest rates remain flat for quite some time, with potential rate cuts only later next year. But the point for us is that we think, you know, we are entering a period of higher for longer interest rates. So we do not expect the cutting cycle to be steep. In fact, we think it will be shallow.
Mamello Matikinca-Ngwenya is the Chief Economist at FNB. Thank you very much for your time.